Okay, seminar LP3, financial statements, the income statement, balance sheet for a businessman. LP3 assignment states that the bank approved your loan and you have to prepare a budget sheet. The assignment also states to think about an income statement and a balance sheet to help guide you. We will briefly review both the income statement and balance sheets, and then we will discuss how your financial business section will be slightly different from a regular financial statement that you are used to seeing. Financial sections for a business plan. The financial section of a business plan is not exactly the same as a regular financial statements because accounting looks at the past or the history of what happened for the company. A business financial plan is about forecasting or taking a forward view. The most important reason to create a financial forecast is for your own benefit, so that you understand how your project will, how you project your business will do. However, investors and the banks will want to see it as well. So your forecast must be based on a realistic model. You must justify your projections. You have to have some kind of model that you're working for, or an estimate. The income statement, which has to be the first financial statement that is prepared, is used to determine whether a company earned a profit or incurred a loss during a specific time frame. Revenues from a specific time period minus cost of goods sold minus operating expenses from the same time period. This is known as the earnings before taxes, or EBT, or operating income. You then subtract income taxes to arrive at the net income, or the bottom line. The balance sheet consists of the accounting equation assets equals liabilities plus equity. Assets are items that hold economic value for the company. Liabilities are obligations for the company to pay. Equity consists of capital for sole proprietors and partnerships, or shareholders' investments and retained earnings for incorporated companies. Here's just a quick balance sheet item. You can see it's not nearly as detailed, and I didn't include an example of an income statement, but it's revenues minus expenses that we've talked about in the previous slide. But anyway, this is just a quick overview of what how it's not detailed like you would see it. You see that it's opening, you started March 1st, ending as of the ending of July 1st of first year, and then it's ending as the second year. It's just a forecast. So the forecasted income statement, whether you are opening a new business or expanding an existing one, you will not have actual revenues or expenses. You will need to forecast both the revenues and the expenses over a 1-year period for 3 years. In other words, you will have to construct an annual forecasted income statement for 3 years. The forecasted income statement will show investors such as banks, governments, and private entities if and when your business plans to make a profit. How to create a forecast. Start with the sales forecast. Project your sales for a 3-year period. Set up different sections for different lines of sales and columns for every month for the first year, and either on a monthly or quarterly basis for the second and third years. Calculate cost of goods sold, or cost of sales. Gross margin is sales less cost of sales, and is a useful number for comparing with different standard industry ratios. For a new product or a new line of business, you will have to make an educated guess, but it must be based on realistic numbers justified by a model. The sales budget consists of 6 parts. You have to forecast sales in units, forecast sales in dollars, forecast monthly sales percentages, determine your forecasted monthly sales in units and in dollars, determine when customers will pay you, and determine your forecasted accounts receivable. So your first part, determine your forecasted sales in units. A unit can be defined as the product or service in which you plan to sell. For instance, if you're selling televisions, each television is considered 1 unit. Your task is to determine the number of units your business will sell in its first year of operations, its second year of operations, and its third year. And here you can see I just threw in a little example here. So it's just, I based this on, I just threw some numbers out there, but you will have to base it on some kind of logic. So the following items should be considered when forecasting your sales in units. The economic conditions, your pricing policies, your sales force, the season or the cycle of your product, past sales, if you have any. Now, if you are making a branch of an existing company, You can maybe take a certain percentage of that company and say, well, we predict, based on what another branch might have done, that they sold 10% of this branch, or 50%, or whatever. Um, Promotions that you might be running, the competition, the size of the market, and the production capacity. Part 2, determine your forecasted sales in dollars. To determine your forecasted sales in dollars, multiply your forecasted sales in units by your selling price per unit. If you're selling more than one product or service, you will need to calculate the weighted average selling price first. Okay, so you can see on the first year that I projected $3,000. I'm determining that it's going to cost me $26. I'm going to sell it at $26 per unit. And the forecasted sales in dollars is, I'm just taking the 3,000 times the $26 and I get my 78,000. The monthly sales percentage is part 3. The sales budget involves predicting when sales will happen. This is done by assigning percentages to each month of each forecasted business year. So if you notice on the first year, and I kind of cut this down to just 2 years because it was kind of too big, but you see January, January, February, March, April, May. I think my business isn't actually starting in, well, I think it started in, yeah, it's not starting till June. So I didn't have any sales until till June. Okay, so, and I only predicted I'm only going to sell 5%. In July, 13%, 2022. October, it's getting kind of my slow season maybe, and I'm just putting these predictions. This is what I would sell during these months. This is just an example, but you'll have to base yours on how you determine it. Could be the time of the year too. So part 4, determine your forecasted monthly sales in units and in dollars. To determine the monthly unit sales, simply multiply your forecasted monthly sales percentages by your forecasted yearly unit sales. To determine the dollar sales per month, simply multiply your monthly unit sales by your selling price per unit, or weighted average selling if you're more than one type of product. So if you follow this sheet here, so I have I took this from the original. This is what I originally predicted, my sales percent. My forecasted yearly sales is going to be 4,000. So units and sales each month. So notice down here, it didn't start till June. I took my 200 divided by my, or times my 26, and that's where I came up with my dollar sales each year. Okay, part 5, determine when customers will pay you. So this calculation depends on if your company's granting credit. So if your credit granting policy states that your customers have 30 days to pay for the products then they buy, then cash from sales made in any given month will not be collected within the following month. Because, for instance, if I sold something on June 15th and I'm giving a customer 30 days, and they don't have to pay me until July 15th. So now I'm collecting that in the next month. So part 6, determine your forecasted accounts receivable. An accounts receivable is a promise made by a customer to pay for products or services at a later point in time. Companies offer credit terms as an added service to customers in an attempt to increase sales. When you as a customer purchase something on credit, the company you purchased the product or service from will consider you an accounts receivable. So here, in the example, we have forecasted sales expected during the current year, a certain amount of dollars, minus my cash collected from customers, because remember, I'm not going to collect it all, and add the forecasted receivable prior to the current year, amount owed to you by the customers. Your assignment is to create a sales budget for your company, whether you have a product or a service. So if there's any questions, do not hesitate to contact me, and I will be more than happy to help walk you through this.